Hi, good morning or good afternoon, depending upon where you're joining us from today. Welcome to our webinar, The Next New Normal, Green Energy Perspectives and International Opportunities. This is a co-sponsored event series by Thompson Hine and the U.S. Department of Commerce, and we are very excited to have our speakers here today. This is the second program in our Next Normal new series, a series focused on international business and legal topics. My name is Roger Bora. I'm a partner in Thompson Hine's Intellectual Property Group and will serve as a program facilitator today. Now, before starting the program, we do have to go over some housekeeping items. Today's program is being recorded. We will send a follow-up communication to attendees with the presentation slides and the recording. You can also find copies of the PowerPoint slides in the agenda. It should be in the handout section on your webinar screen. For any questions today, we will be asking you to provide those questions in the question box located in the control panel on the right side of your screen as well. We will answer as many questions as we can during this program. If we do not get to your questions, we will follow up by email or phone. We are also providing CLE for today's webinar. If you are seeking CLE credit, be sure to complete the attendee verification form, and please also complete the optional feedback form. These forms are in the handout section of the control panel, again on the right-hand side of your screen, and the document is entitled Links, CLE Verification Form and Feedback Form. We will also paste those links in the chat section at the end of the program. I will also be announcing CLE codes today. So during the program, I will announce 2 CLE tracking codes at the middle and at the end of the program. We also have a disclaimer, if you can see on the slides. We just want to make note that this presentation is intended for general information. The thoughts and opinions expressed are only those of the individual panel members, and the content should not be taken as advice. So to get started, I am joined today by my Thompson Hine colleagues, Kevin Tabor, a partner in our tax group, and Greg Chafee, a partner in our corporate transactions and securities and energy groups. I'm also joined by Debbie Durr of the U.S. Department of Commerce in the Cincinnati, Ohio office, and Marcelo Oriana of the U.S. Department of Commerce in the U.S. Embassy in Santiago, Chile. In addition, Debbie will facilitate your questions during the session today. Our first speaker is Kevin Tabor. Kevin is a partner in the firm's tax group. Kevin frequently advises clients on all aspects of corporate and partnership taxation, with particular experience in cross-border tax matters. Kevin, the floor is yours.
Thanks, Roger. And it's a pleasure to speak to everybody today on today's webinar. As Roger indicated, I'm a tax partner, so I'm going to be spending my portion of the presentation today discussing the energy investment tax credit, and then in particular how it has been impacted and affected by the recent Inflation Reduction Act of 2022, which is commonly referred to as the IRA. So if I use the acronym IRA today, I don't mean a retirement account, I mean the Inflation Reduction Act. So the investment tax credit itself has been around in one form or another for many, many years. Prior to the Inflation Reduction Act, it was a 30% credit that was available for renewable energy projects, okay? And the credit is calculated based on the eligible costs. So essentially what a taxpayer pays for a project. With the Inflation Reduction Act, though, it was modified considerably, and so the credit is now theoretically 6% of eligible costs, but it jumps back up to the 30% rate if the project itself is less than a megawatt, so your smaller projects. If the project was construction started prior to January 30th of this year, or certain prevailing wage and apprenticeship requirements are satisfied. So kind of going through those a little slower. if you are a small project, so think about the solar canopies you might see driving down the street over a school parking lot or maybe a church parking lot. Those are typically going to be less than a megawatt AC, and so those projects should automatically qualify for the higher 30% rate. All right, but then your bigger projects, they're only going to qualify for the 30% rate if construction of them began prior to January 30th this year, or if construction didn't begin prior to January 30th of this year, then they're going to have to satisfy certain prevailing wage and apprenticeship requirements, which we'll talk about later. So, like I said, a lot more complicated to get to 30% than it used to be due to the Inflation Reduction Act, but there is a path to get there. The last point on this slide to note is the energy investment tax credit as we know it now will go away for projects that don't begin construction prior to 2025, but it gets replaced with this new clean electricity investment tax credit. And that tax credit is what they call kind of technology neutral. So it's available for projects that don't produce greenhouse gases. So for example, solar. But it's technology neutral in the sense that if there were some new technology that was created right in the future that did not produce greenhouse gas emissions, theoretically that project would be eligible for the credit. And so this new version of the investment tax credit, what they call the clean electricity investment credit, that's going to be around until 2032. So there's a long runway for that one, and it could be around even longer. The expiration of that credit is actually tied to greenhouse gas emissions, which is kind of interesting. And so if greenhouse gas emissions are not 25% or less than what they were last year, 2022, then that credit actually will be extended beyond 2032. So a long runway for developers and those interested in building out renewable energy. One thing to note is energy storage technology. So that's just a fancy way of saying batteries. For a long time, there was not a separate credit, an investment tax credit available for batteries. The only way you could get a credit on the batteries is if they were installed in conjunction with solar. And so the Inflation Reduction Act changes that. And so what this is going to allow for is a separate tax credit to be claimed on what they call standalone storage. So a battery that's placed into service not necessarily at the same time as related solar. And this is very important for the industry because as you might imagine, batteries really kind of help renewables, right? The sun only shines during the day, but people don't need as much electricity during the day. And so the battery kind of helps bridge that by storing up that electricity that was generated during the day that can then be used in the evening. Okay, so we talked a little bit about tax credits. The problem, of course, with the tax credit is it only has value if you have to pay tax. And so if you're a developer out there developing renewable energy projects, you only make so much income and you only have so much tax for which to credit. And so the industry has developed different models, what they call tax equity structures, that help these developers to what we call monetize the tax credits, right? To get the tax credits used by somebody else that could actually use the tax credit. And so the common structures that are used today are partnership flips and sale leasebacks, and I'm going to talk about those each here in a minute. And then the Inflation Reduction Act also created a new way of transferring tax credits without really using what we call a tax equity structure. So starting with partnership flips, it's kind of complicated, but generally pretty simple. So what happens here is a sponsor or a developer finds somebody else, right, that could use the tax credit. Typically, this is a big bank, and they agree to form a partnership. And the partnership then holds the project either directly or through a subsidiary. And the tax partnership in this case here sells the power that is generated by the project, whether it's a solar facility or a wind farm, to what we call an off-taker, and that's just the party that is using the power, that is buying the power that is generated by the wind farm or the solar facility. And the way this works is for the first roughly 5 years or so, the tax equity investor here is allocated 99% of all the income, losses, and the tax credits generated by the, let's call it a solar facility, okay? And so this is a way, as I said at the outset, to essentially transfer the tax credits without saying you're transferring them to another party, in this case, the tax equity investor that can use them. The reason for the word flip is because after a certain amount of time, some partnership flips, it's when a certain amount of time has passed, let's say 5 or 6 years. Sometimes it's when a certain yield is reached. But once you get to what they call the flip point, the tax equity investor is only going to get 5% of income losses and credits, and the sponsor or the developer gets the 95%. All right, and usually at that point or soon thereafter, the sponsor also has a purchase option available to it, allowing it to purchase the project at fair market value. So kind of a complicated structure, but it allows for the project to get built. It allows for the sponsor to transfer the depreciation benefits and the tax credits that it cannot use to somebody, in this case, the tax equity investor, that can. So this is a structure that's been around for many, many years, commonly used for your larger transactions, your utility scale transactions, and so not something new due to the Inflation Reduction Act. Another common structure is a sale leaseback. So once again, the goal here is for the sponsor to allow somebody else, the tax equity investor, to use the credits and to get to use the depreciation. And so here, here in this type of structure, the sponsor will typically form a subsidiary, all right, and the subsidiary will sell the project, so like the solar farm or the wind project, to the tax equity investor, and the tax equity investor will immediately lease it back to the lessee in this diagram here, okay? Since the tax equity investor is the owner lessor, it is permitted to claim the tax credits on the project and claim the tax depreciation on the project. The lessee then sells the power that the project generates to an off-taker. That helps fund the lease payments. Once again, usually there is a purchase option at fair market value. Sometimes there's multiple within the lease documents. These purchase options are always after year 5. And the reason I keep mentioning that is there is a recapture that would occur of the tax credits if the project were to be sold prior to 5 years after the project is placed in service. So in all of these transactions, any purchase options you see will always be after 5 years in. But similar to the project flip or the partnership flip, the project itself is operated by the lessee or by the developer or maybe by a third party pursuant to an O&M agreement. The tax equity investor is purely passive and purely I don't like to say this as a tax person, but providing the quote financing for the deal. Okay, so Inflation Reduction Act kind of created a new way of doing this, and so like I said at the outset, the goal of these structures, whether it be a partnership flip or a sale leaseback, was to transfer the credit that the developer doesn't need and can't use to somebody else, like a bank, that does need the credits and can use them. And so what Congress did here in the Inflation Reduction Act is they allowed for a direct transfer of the tax credits. They basically said, hey, you don't need to do a partnership flip. You don't need to do a sale leaseback. We'll just let you sell the credits, okay? And so That went into effect this year. There are still no regulations on it, but it's generally understood based on what's in the statute now that, for example, a developer could sell an investment tax credit to a buyer. These credits can only be transferred once. Has to be paid for in cash, and so this is a way, like I said, to transfer the credits. Now, there will still be partnership flips going forward. There will still be sale leasebacks going forward. And one of the big reasons for that is you can't transfer the depreciation, and the depreciation has value. So this new provision only allows you to sell the actual credit. Another thing that's going to be important here is there's going to be significant indemnities, I would think, required by the seller. Okay, so if I'm the buyer of a credit, I want to make sure that I'm going to get the full value of the credit, right? That there's not going to be any recapture of the credit. There's not going to be any, issues. And so if I'm a buyer, I'm going to be looking to the developer or whoever transferred it to me to provide a pretty substantial indemnity that, if the IRS comes calling, that they're going to step in and pay, any tax, penalties, or interest that might be due. Last point on the slide, the tax exempts. States, universities, and the like, they are actually now able to get cash in lieu of, it's called direct pay, in lieu of a credit. And so if a tax exempt is looking to, claim the investment tax credit, but obviously, maybe doesn't need it because they don't pay tax, there is an ability now for them to get a cash payment. Okay. Real quick here, just wanted to touch on the wage and apprenticeship requirements. This is something new that was added by the Inflation Reduction Act. As I said at the outset, unless a project is small or unless the project began construction before January 30th this year, it's going to be required to meet these wage and apprenticeship requirements. All right, and not only must it meet them during the construction of the project itself, but it also must meet them with respect to any alterations and repairs during the first 5 years the project is placed into service. So something to keep in mind on the bigger projects and on projects that begin construction after January 30 of this year. All right. Another new thing added by the IRA or the Inflation Reduction Act is the ability to actually increase the tax credit beyond 30%. And so you can actually increase it by 10, which will get you to 40 if your project is located in an energy community. And an energy community is essentially one of three things. It is either a brownfield site, or it is an MSA where at any time after December 31st, 2009, in that MSA, there was 0.17% or greater employment or 25% or greater local tax revenues in the extraction, processing, transport, storage of coal, oil, or natural gas. So essentially fossil fuels. So if the project is located in an area where there's been a lot of fossil fuel jobs, it has a chance of qualifying for an energy community 10% bonus credit. It also must have, as you see in that second bullet there, an unemployment rate, okay, for the previous year higher than the national average. Now, there's some debates amongst tax practitioners. What does previous year mean here? It's probably one of two things. It's either the year prior to the year the project was placed into service, or it's the year prior to when the construction of the project began. But we don't have any regulations or any other guidance yet from the IRS on this topic. All we have is the statute, which is on the screen here. So we're hoping to get more guidance on that soon. And then the last way to qualify as an energy community is if it is located where there was once a coal mine or a coal-fired electric generating unit or on an adjacent census tract. So I've seen some interesting white papers on this. particularly with respect to the second kind of way to meet this here, the MSA with a fossil fuel job base. Some people are saying that a good portion of the country probably qualifies as an energy community under that test. So it's definitely something to look into for all of your projects because it would generate an additional 10% ITC if it is indeed in an energy community. Okay. The next way to get an additional 10%, and once again, these are all adders. And so if you were in an energy community and you have what's called domestic content, you could actually get the 50% ITC, but and they're completely independent of each other. So you don't have to be in an energy community to get the domestic content 10% and vice versa. But this is one of the more controversial parts of the Inflation Reduction Act because it directly incentivizes projects to use U.S. Manufactured steel and U.S. manufactured products. So as you can see here on the screen, to qualify for this additional 10% credit, all steel and iron that is used in the project must have been manufactured in the United States, and at least 40% of the cost of all manufactured products, once again, must have been manufactured in the United States. So I know this particular provision, as well as some others, have caused a great deal of frustration, particularly in Europe. I know the EU president was just in the United States visiting with Joe Biden, and news reports were that she raised some of the provisions in the Inflation Reduction Act prior to actually discussing Ukraine. So I know this is kind of a hot topic internationally because it is a subsidy, so to speak, of the U.S. Manufacturing economy. So, but like I said, once again, it's another way to get additional credits, and it is certainly going to be encouraging U.S. manufacturing. Okay, the last slide here is some additional credits. So we spent the vast majority of the presentation so far talking about the energy investment tax credit. Okay, and that's just one credit that is available. There are numerous others, and I think some of the other presenters today might be spending some time on those as well. I'll note a few here. So there's the production tax credit. That is a credit that has been around for a long time as well. That is not a new credit as a result of the Inflation Reduction Act. But the production tax credit, instead of calculating the credit based off the cost of the solar farm or the cost of the wind farm, which is how the investment tax credit is calculated, the production tax credit looks at how much electricity has been produced, hence the name production, by the solar farm or more commonly by the wind farm. So that's the production tax credit. The other credit on here that I want to take a minute to talk about is the advanced manufacturing production credit. That's the last one here on the slide. That is a new credit from the IRA. It is controversial for the same reasons I just mentioned a minute ago, because it is incentivizing U.S. manufacturing. And so this is a credit available to those manufacturers who produce components, okay, of renewable energy projects. And so that would be like the modules or the inverters or the wafers. All right. So once again, a subsidy, so to speak, to the U.S. Manufacturers to encourage the continued development of renewable energy projects in the United States. So with that, it looks like I got about 30 seconds. I don't know, Debbie, were there any questions before I hand it over?
Thank you, Kevin. Great information. We did get a few questions. One is it possible to transfer the energy investment tax credits to an individual, or can they only be transferred to a business?
Thanks. So that's a good question. So yeah, in my slides here, I was kind of always assuming a business. Theoretically, you could transfer these credits to an individual, but the problem would be, unless the IRS changes this, they can't, in most cases, actually claim the credit because of a rule called the passive activity rules, which generally requires individuals to be actively involved, in this case, in the solar farm or in the wind farm, to claim any tax credits that are generated by that wind farm or by that solar farm. And so for that reason, these credits are typically only claimed by large, what we call C corporations in the United States, who don't have to abide by the passive activity rules.
Okay, great. Thank you. And then we had another question. Why does the amount of the tax credit change based on things such as prevailing wages, whether the project uses U.S. steel, et cetera?
Sure. So a lot of that came in with the Inflation Reduction Act, and the honest answer is politics. There was a lot of debate, particularly in states within the U.S. that had traditionally had fossil fuel coal mining type jobs, and so the politicians were wanting to make sure that if we're going to be migrating towards renewable energy, that the folks that are going to be working in the renewable energy space are going to be paid prevailing wages, and are going to be manufacturing, in the United States. And so that is purely, policy and politics.
Okay, great. Thank you so much, Kevin.
Very good.
So we'll move on to the next section of our program. I want to thank Roger, Bora, and everybody at Thompson Hine for coordinating this program and for their partnership. I'm very happy to have my colleague with us today, Marcelo Orellana. Marcelo is with our U.S. Embassy in Santiago, Chile, and we'll hear from him in just a few minutes. But for those of you who aren't familiar with our federal agency, the U.S. Commercial Service, I'd like to tell you what we do for U.S. exporters. The U.S. Commercial Service is the trade promotion arm of the U.S. government, located in 100 U.S. cities and 80 countries. We're one of three divisions, and I'm trying to advance the slide. Thank you. We're one of three divisions under the big umbrella of the U.S. Department of Commerce's International Trade Administration. Our network of trade professionals consists of international trade specialists like me in the U.S. offices and foreign colleagues in U.S. embassies and consulates around the world. I'm with our Cincinnati office, as Roger said earlier, and I service the greater Dayton region from a satellite office housed with Wright State University. Your local trade specialist, wherever you're located in the U.S., will be glad to work with you to develop an export strategy for your company and build a team to help you with every aspect of doing business internationally. U.S. trade specialists like me work closely with our colleagues on the foreign side who are in the other countries. Where we don't have staff in a country, we partner with the U.S. Department of State to provide the same support and programs. Our foreign colleagues are assigned portfolios of specific industries, which results in their having a wealth of knowledge and insight about those markets and sectors. They know the channels of distribution, the industry trends, the companies and business organizations in their respective markets. They also work on trade shows for those industries. They, in turn, report to our commercial officers who are U.S. citizens serving abroad in the commercial service. This results in your business having an incredible wealth of knowledge at hand to help you enter a market, which is our primary focus. We want to provide your company with all the information you need to assess a market, counsel you on the entire export process from the U.S. side, including U.S. export laws, and offering programs to help you find qualified distributors, agents, or partners to sell into a country. We also have industry and regional teams that coordinate some great programs, including those offered at trade shows. So as an example, For a trade show, we'll recruit foreign buyers to come in delegations with our colleagues from those markets to meet U.S. companies or provide U.S. companies with one-on-one market-specific counseling. We also have colleagues in Washington, D.C. who can help U.S. firms with advocacy or if there are any unfair trade practices in another country. And we have colleagues who work on specific areas like international standards, specific industries, and specific countries. So if you need to know about U.S. sanctions for Russia and Belarus, EU directives, or the China CCC mark, we can definitely help. To sum it up, you're never alone if you want to develop an export plan, sell into a new market, or increase export sales if you're already in a market. You can find all of our office listings and resources on our website, www.trade.gov/CS, or feel free to contact us in the Cincinnati office. And our contact information is there on the screen. And now it gives me great pleasure to introduce my colleague in Chile. Marcelo Orellana is a commercial specialist with the U.S. Commercial Service, U.S. Department of Commerce at the U.S. Embassy, Santiago. He has over 10 years of experience helping U.S. companies enter the Chilean market. His industry portfolio includes the mining and energy sectors, among others. Before coming to Commerce, Marcelo also worked in private industry in the U.S. and Chile. So Marcelo, I will turn the program over to you.
Thank you, Debbie. Well, good morning or good afternoon for those connected in other time zones. During this presentation on opportunities in Chile's energy sector, we will first provide a basic information on the sector, followed by some market conditions and key sector goals as they relate to the participation of renewable energies in the country's energy matrix. Then we will describe some key facts and figures, followed by the market challenges, and we will end with opportunities. Chile's Ministry of Energy has set a goal of becoming carbon neutral by the year 2050. The key actors for reaching this goal are both international and local private companies. The international companies are coming mostly from countries with which Chile has signed free trade agreements, over 60 to date, and one of which is the US. The government role, that is the Chilean government role, is that of identifying and facilitating the development of projects by issuing international tenders for power generation, transmission, and distribution of energy. At present, Chile has one of the highest renewable energy participations in its energy matrix. That's why the sector is very confident of reaching a goal, a medium-term goal of 80% renewable by the year 2030. Next slide, Debbie. We now turn our attention to specific facts and figures. Chile has been blessed in many ways. And the first blessing is the amount of solar radiation present in the north, which is the highest on the planet. The second blessing is its 4,000-kilometer coastline with very favorable conditions for the deployment of wind farms. And the third is the strength of the winds blowing almost year-round in Chilean Patagonia. However, on the other hand, a relevant fact is that a large percentage of the population lives in the central area, where neither the sun radiation nor the wind speed are optimal. This fact generates the need for long transmission lines, especially to connect the northern power plants with the central area. Also, having an 80% or 80% renewable grid coupled with a carbon neutral goal generates a need for batteries to back up and provide stability to the grid when the sun is not shining and the wind is not blowing. But commercially available batteries are expensive especially for an emerging economy such as Chile's. Therefore, active efforts to search for more economical battery-based backup solutions are conducted by both government and private stakeholders. Chile is a small country with a population of only 19 million. However, it is the largest copper producer in the world and the second largest lithium producer in the world. Needless to say, the importance of these two minerals in the manufacturing of electric vehicles is expected to increase exponentially in both the short and long term. These two facts are expected to greatly increase the demand for energy, as the mining sector is the largest consumer of energy. Next slide, please. We now look at some of the specific market challenges. If you are a project developer, environmental permits may take more time than contemplated in the original budget. Also, any medium to large scale renewable project must establish early on a close and long-term win-win relationship with the communities in or around the project site. The new normal is such that what used to be a purely administrative procedure for obtaining permits could turn into a lengthy and time-consuming legal litigation with the stakeholders. Also, there are few, if any, subsidies on the part of the central government. Alternatively, if you are a supplier of parts and services, you must deal with Asian competitors like Taiwan, Korea, and the PRC. And this will have to be done in the most competitive and open environment in the Americas. Also, suppliers to the energy sector, whether local or international, operate in a highly sensitive, price-sensitive market. Because of this cultural price sensitivity, Asian suppliers have successfully entered this market. As we know, each market is immersed in a unique cultural environment. Therefore, local business culture expects foreign suppliers to invest time in cultivating personal relationships. And this could become particularly challenging if we realize that less than 10% of Chile's population speaks fluent English. Next slide, please. Considering all the previous slides, opportunities are plentiful in both the project development area and the supply of products and services. Chile realized early on that it had to open its economy to the rest of the world. Therefore, suppliers of parts and equipment ranging from solar panels, trackers, wind turbines, wind blades, batteries, and turnkey energy storage systems, high voltage transformers, substations, transmission lines, control systems, you name it, are coming from around the world. Also, if your company manufactures a high quality part or tool that could be used in the energy generation, transmission, or distribution sector, well, Chile is a stable market to be considered. Market opportunities also include engineering services. It is no coincidence that world-class engineering companies such as Bechtel, Black & Veatch, Fluor, and Honeywell have established their regional offices in Santiago. But these get involved in mega projects, thus leaving room for small and medium-sized engineering services firms for the installation and commissioning of small, medium, and large photovoltaic and wind projects. Chile is a commodity-based economy. Its industrial base, although active, is small. Thus, the energy sector has always relied on imports. In this market, the US brand is well recognized for quality and top service. And in general, US suppliers work with local distributors. And as Debbie indicated at the beginning of this section, the US Department of Commerce, through its network of offices in the US and in the world, can help you search for the right local partner. This is only one of the many services we provide for US manufacturers and exporters and service companies. So as Debbie also indicated, you may contact her directly or you can contact me directly. And if, next slide, please. Whoops. So I'm leaving you the chain of command here, just in case I don't respond on time, okay? So thank you so much.
Thank you so much, Marcelo. Great information. We'll take questions from the audience. I do have one. Let me see if we have any others. So the question is, what would you say is the biggest challenge for a smaller U.S. company when entering the Chilean market in this industry?
Well, thank you. Thank you. That's a very practical question and a very good question. A small or medium-sized company coming into the country, I would say that their biggest challenge is not to make a stop at our offices. That would be the biggest challenge, not to do it. Okay. We as you indicated, Debbie, we're here to support small and medium and also large. But for the majority of the companies we work with, there are small and medium-sized companies, and because of what we do, sometimes they want to keep the information, this valuable information, for themselves. And given that we don't have a marketing department, many a times these services go unheard of or unknown for the most part. So for a small company, I would say I would recommend to stop by and come here and learn about the market from people that are local, as you indicated, Debbie, are locals, that they know the lay of the land and they know what's for the most part is happening in this case in the energy sector.
I so agree with your answer, Marcelo. Thank you. And Roger, I will turn the program over to you.
Thank you, Debbie. Thank you, Marcelo. That was great information. The first CLE tracking code for today is THNN49. That's TH as in Thompson, Hine, Nancy 49. So we'll have one more CLE code at the end of the program. Our next speaker is Greg Chaffee. Greg is a partner in the Corporate Transaction and Securities Practice Energy Group. He is also co-chair of the Water Resources, Technology and Regulation Group. Greg's practice covers a wide range of domestic and international corporate, commercial, transactional, regulatory, compliance, and governance matters with a focus on energy product development, clean technology, and ESG programs. Greg.
Thank you, Roger. Let's turn to connecting the dots between Kevin's discussion of the Inflation Reduction Act incentives and Marcelo and Debbie's global perspective on the energy sector as well. Next slide, please. Sustainability is mainstream as part of business today. It's no longer on the fringe. Reporting and disclosure has become part of commercial practice for companies both large and small. It is not only about value integration in the business, but also about creating economic value for companies, including both profits and nonprofit organizations, and developing a position for a sustainable future that takes on the opportunity for companies to look at a vision that's truly worldwide, as Marcelo spoke about moments ago. Next slide. There are both voluntary and mandatory global sustainability reporting standards. The voluntary standards include what was formerly the Carbon Disclosure Project, or CDP. The TCFD is another example. These sustainability reporting standards generally share common themes and principles, but in practice, they do incorporate different types of reporting requirements, standards, norms for disclosure. Harmonizing those divergent reporting standards is one of the challenges that faces adopting sustainability practices on an international basis. With so many different standards in play, there is an opportunity for questions to arise about the verification, the accuracy of reporting by companies, and the extent to which the data that is reported is able to be traced and tracked on an accurate basis as well. Required sustainability disclosures include new measures that are being implemented on the federal side. The Securities and Exchange Commission recently announced new rules related to mandatory carbon emissions and climate disclosures for public reporting entities in terms both of sustainability and environmental and social governance standards. Those SEC rules will make corporate sustainability reporting more of a common practice and more in line with standards that are currently in place in the EU as well. Next. So what is the status of sustainability reporting by companies domestically? Well, about half of US companies report that they have some cross-functional sustainability group internally, some practice whereby they're bringing together stakeholders internally to entertain sustainability-related policies and practices. About 60% of companies report that they're able to disclose their own Scope 1 greenhouse gas emissions. And about 3/4 of companies report that they are willing to at least disclose Scope 2 supply chain emissions. And that's up substantially from just several years prior to that. But what's less clear is those Scope 3 emissions, dealing with downstream emissions of customers, for example, in the supply chain as well. Less data, less accuracy there too. And in fact, that accuracy of data reporting is a major concern. The completeness of sustainability data is very often a challenge to track, and identifying the metrics and identifying the data to report and doing so in a consistent way is one of the main challenges. Next. So much of this comes down to setting standards within an organization, goals and tactics combined. The goals can vary depending on the nature of the organization, what they're seeking to accomplish through sustainability, ESG related reporting. It can range from preventing emissions to reducing waste to landfills, resource conservation management, and reducing the carbon footprint of an organization. The tactics are really key. And where in an organization does the implementation of sustainability programs and policies and initiatives take place. Next. Some companies have really been raising the bar in terms of sustainability reporting. A good example is Walmart. Not only did they target zero emissions by 2040, they're actually taking a regenerative perspective. That is, aiming to actually restore and bring into use over 50 million acres of land and ocean space by 2030. Home Depot has also set very aggressive targets to reduce Scope 1 and Scope 2 emissions, and has done so while reporting growth of the business at a substantial rate during the period of time. Here's another example of a corporate goal of reaching 100% renewables within a very short period of time, in this case by 2030. We've talked to a number of different companies about their sustainability practices and reporting. In some instances, companies say, well, we've changed the light bulbs. We're now using LED bulbs. And that's great as far as a step in the direction of power reduction steps, but it is not a sustainability policy or program that in the current environment is going to be able to withstand the scrutiny, most likely from both the perspective of global voluntary standards as well as the perspective of the regulatory compliance needs that are coming into play. Next. Renewable energy is growing at an accelerated clip. About half of all the new electric capacity that was added to the power grid last year is solar, and that's a record-setting amount. And solar is, again, increasingly competitive compared to natural gas or fossil fuel technologies. The share of solar production has risen substantially from just a fraction 10 years ago to almost 5% of the total energy generation capacity today. There are some signs of challenges as far as the speed of implementation. Solar installations would generally be higher across the board, except for supply chain constraints and pricing. Costs have increased across the market segments in recent quarters, with utility scale prices rising most significantly since 2021. Those price increases have impacted deployment, although with the Inflation Reduction Act incentives coming into play, there is an expectation that that growth will start to take a more robust trajectory in 2023 and beyond. Next. Bottom line is that solar power is fundamental now in the business environment, and major companies have invested heavily in solar power, including major names such as Amazon, Target, Apple, and others. The top US corporate solar power users have ramped up capacity significantly, over 8,300 megawatts in over 40 states. And that's in a period principally within the last 3 to 5 years. The data from the Solar Energy Industry Association shows that about half of solar power capacity was installed just within the last 48 months or so. Next. So this slide represents that there is an abundance of data. Not only is solar energy on the rise, but the information that's available for prospective adopters and users of solar power is also a tremendous area for tapping into. And to the extent that companies, businesses have an interest in utilizing solar, there is a tremendous field of information to be generated here. Next. So what are the most common types of contracting for solar power projects? Well, power purchase agreements involve the delivery of power from the project to an end-use customer, and often involve the utilization of renewable energy credits, or so-called RECs as well, which can be traded and can provide an additional incentive in terms of reporting carbon reductions, as well as a financial incentive for projects. But what we are also seeing is a rapid increase in so-called virtual power purchase agreements, or VPPAs. These are hedge contracts where the power producer is actually selling electricity into a spot market and exchanges that revenue for fixed payments from a customer. So the point is that a customer based in the United States could actually be sourcing electricity from a power producer internationally. It might be in Chile, or it might be in Europe, or in Asia for that matter. So VPPAs are especially ideal for customers that have multiple facilities where there are no specific supply points, or where there are constraints in terms of installing physical facilities. Next. What are some of the benefits of virtual power purchase agreements? Well, they are pricing mechanisms, and in that respect, they are more complex to structure than a typical supply and purchase relationship under a traditional power purchase agreement. They do involve financial risk, but they do as well enable users to make very quick progress towards achieving their renewable energy goals. And that has contributed to VPPAs being one of the most accelerated solar transactional structures that is in the market today. Next. VPPAs are scalable. They enable their users to obtain sustainability goals quickly. Several examples, one of which is Fifth Third Bank, which announced that it met 100% of its renewable energy goals with a single virtual power purchase agreement. Other companies such as Home Depot are buying substantial volumes of solar power and wind power from remote locations to provide electricity for powering up their stores on a national basis and a regional basis as well. We're also seeing an increasing emphasis on rooftop deployment of solar related to commercial warehouse buildings or data centers, for example, that provide a large expanse of flat roof facilities and can be a very economically viable way to utilize a rooftop that would otherwise not be generating a revenue stream. But there are opportunities for companies that want to dip their toe into the water of utilizing renewable energy. It can start with carports even, for example. A parking lot can be turned into a solar generator by virtue of having a canopy system installed. These are relatively low cost and easy to develop projects that allow for a gateway before ramping up to develop more expansive projects in some instances. Next. We're also seeing a tremendous increase in the volume of energy efficiency projects. ESCOs, or energy service companies, are focused on developing and implementing energy saving projects that include the monitoring and measuring of conservation of electricity, water, and other resources. And many of these ESCO projects involve very complex financing arrangements, off-balance sheet structures, for example, that help to reduce the energy costs to a facility. The payback can be a very well-structured approach in the contracting. Can be done over a period typically of 5 to 20 years in most instances, or the energy cost savings can be reinvested into a host facility. Next. So what are the drivers for this increasing investment in renewable energy? Well, certainly public policy is at the forefront, and as Kevin discussed with the Inflation Reduction Act, that is a key factor in terms of bringing dollars into the marketplace. The 30% investment tax credit, a reduction of tariffs on imported solar equipment, and also state incentive programs. Technology improvements are driving investment. Battery storage is becoming more commonplace and more affordable in terms of both standalone as well as supplemental efforts to allow peak demand and time of use rates. And overall, although there have been some spikes, as we discussed a moment ago in the pricing, the prices for on-site commercial solar systems in general have been declining over the last few years. Next. A lot of money is going into the renewable energy marketplace today. Tax equity commitments in 2022 were about $18 billion, a significant 10% increase over a year before. The debt market in 2022 was a volume of almost $100 billion with a record 200 deals that were publicly reported. That's a substantial increase from 2021. Also, the number of lenders, of investors in the marketplace has substantially increased within the last several years. The reports are that close to 100 project finance lenders will be in the marketplace in 2023. The trends are that sustainability project lending will remain strong. There is some uncertainty based upon global economic situations, inflationary pressures, but the industry analyses tend to be very favorable in terms of reporting on investment on a going forward basis. Next. The Inflation Reduction Act, which we spoke about earlier, will have a tremendous impact on investment. Almost $370 billion in energy security and climate change programs and carbon emission reductions is expected within the next few years. Next. The IRA provides that ramp, as Kevin discussed, for tax incentive stability. The Solar Energy Industry Association is expecting that deployments will increase by 40% or so over the next 5 years, and that market investment will reach a spike as high as $22 billion by 2025. Next. In addition to the federal incentives through the IRA, a lot of the growth in renewable use has been through state-related incentives. The renewable portfolio requirements that at the state level require utilities to utilize a certain percentage, purchase a certain percentage of renewable energy in order to meet mandatory requirements under state laws. Those standards have incentivized a tremendous growth of renewables in states such as California, as one would expect. New York, New Jersey have also shown marked growth due to those standards in place. But we're also seeing growth in renewable adoption where there are no mandatory requirements. For example, in the Southeast, in the state of Georgia, there is no renewable portfolio standard, but voluntary efforts between the utility and developers of renewable energy have promoted the growth of distributed generation solar in that market, so that Georgia is now ranked 7th in the country. That's an example where different policies, different implementation on a state basis can lead to very powerful development of renewable energy use and consumption. Next. Kevin mentioned the production tax credit. The option to utilize the PTC and for project developers to receive a tax credit for the electricity they generate has also been a significant catalyst. Organizations that do not have a tax burden, nonprofits and local governments, are also able to take advantage of the tax credits through the direct pay or transfer as well. Next. Domestic content has definitely stimulated manufacturing activity. We are seeing rapid number of announcements of new domestic manufacturing. In some cases, it is international companies that are moving their production into the US market. Recently, there have been a number of announcements of module and solar cell production moving into the US. We are also seeing some efforts by domestic companies, in certain cases even startup organizations, to develop domestic production capacity. Challenge is to raise capital in some of these instances, particularly where there are large multinational companies that are pushing production domestically for new entrants. Though there are a variety of incentives available, raising that capital in a highly competitive environment will be a challenge going forward. Next. Location really is key. What we're seeing in project development is that focus on how do we take advantage of the incentives such as energy communities by locating projects on brownfield sites or the census tracts where coal mines have closed, for example. That has been a definite driver and an impetus for investment, and the geographic siting is a key consideration. We, for example, were involved in a carbon sequestration project to repurpose a fossil fuel power plant in the Southwest. And one of the main incentives was the ability to link into the transmission grid, to utilize brownfield site location, as well as a coal mining location, all in combination to create a more attractive project from an investment perspective. Next. Technology. The IRA authorizes a substantial amount of loan authority for projects available principally through the Title 17 innovative clean energy categories. For new technology development, this is really the gold mine now of an opportunity to advance projects that have, in some cases, been on the sidelines for multiple years. Next. The IRA is boosting investment in innovative technologies, particularly fuels for powering aviation, transportation, renewable natural gas, as well as battery storage and carbon capture. Renewable energy producers are particularly attracted to hydrogen as a method of production because of the potential demand for renewable energy to make it as well. Next. Electric vehicles, we touched on before. The IRA vehicle tax credits run through 2032. The vehicles do have requirements as far as North American production, including the use of critical materials and battery components that are sourced domestically from qualified partners. Next. Grant funding is another area that is coming into focus. There are multiple new federal grant opportunities, both arising from the Inflation Reduction Act as well as other federal legislation. And in some cases, these are hard to find programs. It requires a bit of sleuthing through the Federal Register, but the opportunities can be substantial depending upon the nature of the project, depending on the siting, location issues, whether there are workforce incentives, whether there are opportunities for economic development associated with project, initiative, or technology. We are seeing these grants as a real catalyst for bringing new technologies into the marketplace. For example, we're working with a company that's developing coal ash remediation technology linked to solar, and that has been very much incentivized by grant funding from the Department of Energy, as well as other programs through Department of Agriculture, state programs, and even local initiatives. Next. Energy management really is the key. Reducing energy costs by managing energy efficiently, demand response programs is good both for companies as well as for end-use facilities, for utilities. The U.S. building sector is a major consumer of electricity. Over 40% of the energy produced each year is consumed in that sector. So we are seeing utility efforts to incentivize electricity reduction and power consumption trends to reduce on a more general basis. Next. Some of the utility incentives include rebate programs for installation of air conditioning, advanced lighting, roofs, chiller equipment. Other incentives pay commercial companies for energy saving and energy efficiency projects that are based upon reduced peak demand. Next. So the right strategy really depends on what are the needs and interests of the company, the business, the off-taker, the user of power. Questions that can be asked are really specific to the organization. Are there environmental targets and sustainability goals to be met? Is there a desire to avoid upfront investment and time to develop, construct, and operate renewable energy projects? Are there space constraints that can lead to a desire to utilize VPPAs, for example, rather than constructing a physical facility on site? The real key here is that there is a menu of options for implementation, and the variety means that companies, businesses, profit and nonprofit organizations can pick and choose and right size the utilization of renewable energy and energy efficiency projects based upon their needs.
Excuse me, Greg, you've got 1 minute left.
I'll turn to questions, I think, at this point.
Okay, great. Thank you. Excellent information. We do have a few questions here. One is, will tax equity percentages for renewable energy projects change because of the Inflation Reduction Act?
Yeah, the answer is yes. Tax equity has been about 35% of the capital stack for solar. It has been about 65% plus or minus 10% for wind power. Tax equity is expected to be a larger percentage of the capital stack. The ITCs on utility scale projects could jump as high as 30% or 50% even, depending on the project location and the percentage of domestic content.
Okay, great. I think that's all the time we have for questions. Roger, I'll turn it over to you.
Great. Thank you, Greg, and thank yous to Kevin, Debbie and Marcelo on the camera. For the last CLE code, we have THUS 18. That's TH as in Thompson Hine, United States 18. Please feel free to reach out to our speakers with any additional questions you may have. And thank you for attending today's webinar. If you are not currently receiving Thompson Hine's updates and invitations, we invite you to Thompson Hine's website and register to receive our mailings under the Publications tab. This concludes our webinar today. Enjoy the rest of your day and stay well.